I'm afraid I'm a bit of a politics junkie, so it's probably not the kind of thing I should admit because I know there's a few people watching us today, Eugene. But I am fascinated by politics, and I quite happily sit and watch election results for 12 hours non-stop, which was the case with regard to the United Kingdom. But okay, yes, we had very interesting elections in France, very, very interesting elections in the UK. But as you say, the mother of all elections awaits us in November, and I can't wait. However, obviously, all eyes in Washington, in fact, I reckon the eyes of the world were on 90 minutes when Donald Trump and Joe Biden had that presidential debate. And I don't know how many of you watching this watched the entire 90 minutes. I watched it all, and I think it's one of those expressions, what has been seen can't be unseen. And obviously, Joe Biden, the president, had an absolutely appalling debate. Full stop. It doesn't matter whether you like or dislike Joe Biden. It was a complete catastrophe. Since that time, there's been a movement within the Democratic Party itself amongst the leadership to ask Joe Biden to step down. But as we know, and I've written about this, in fact, in my pain report, initially actually in February of this year, there's only one person who will be able to tell Joe Biden to step aside and not contest the US election in November, and that is his wife, Dr. Jill Biden. For the moment, the Biden family are standing firm and basically urging Joe Biden not to withdraw his candidacy. And so that's the state of play in Washington. But a couple of quick observations. First and foremost, I still believe Trump will win the November election. I said that many, many months ago. And the events following the Biden debate debacle has only strengthened my degree of conviction because, as you all know, ignore the national opinion polls. That's not the way the electoral system works in the United States. The president is elected by an electoral college, and therefore you've got to look at the critical battleground states. And obviously, Wisconsin, Michigan, Pennsylvania, Nevada, Arizona, North Carolina are the critical battleground states. And at this moment in time, I have Trump leading in all of the core 7 battleground states. That will secure him a second term in the White House. So don't look at the popular opinion polls. They're irrelevant because of the calculus and the nature of how the Electoral College works. So a couple of very quick observations, Eugene, if I may. If we assume, as I do, that Trump is going to win in November, we've got to brace ourselves for a second Trump term. We know a lot about Trump already. We know that he's going to implement tariffs pretty much across the board, but particularly against China. We know that he will continue a very aggressive fiscal stimulus program. But of course, Biden's already delivered that. Net, I think a Trump presidency will be at the margin inflationary. Also, Trump doesn't like a strong dollar. He thinks that countries that have weak currencies are kind of cheating in terms of their exports. So he doesn't like a strong dollar. Furthermore, he doesn't like high interest rates. Which property developer do you know likes high interest rates? And I believe, and this might be a little bit controversial, I think he'll have a fireside chat with the Fed chairman, Jerome Powell, soon after he wins the election in the end of this year. And once he's inaugurated, post January the 20th, 2025, he'll bring in Jerome Powell and he'll ask him to lower rates. I know that might sound a little bit controversial, and I then believe Jerome Powell will resign. If Jerome Powell doesn't resign, I think Trump is going to fire him. So, I'd put that out there, and obviously I'd probably make a fool of myself yet again, having said all of that. So ultimately, I think a Trump presidency would at the margin be somewhat more inflationary and, of course, also very protectionist. So I think we can begin to instill that into our thinking about investment markets.
And it's interesting what you were saying about the US election, we've talked, and there's been a lot of public commentary of people who feel that, and I think you're in this camp as well, that uh, Jerome Powell wants to cut rates to try to reduce the odds of Trump winning the election. Um, and and that's a nice segue into the next thing we want to talk about, which is essentially US inflation. Um, we've got an inflation number coming out on Thursday, the 11th of July, US time, I suppose. And what should we expect given the slight slowing of inflation in May in the US? That is 3.3% down from 3.4%. So inflation does seem to be at least stabilizing in the US. So and then you've got a slightly softening labor market also. So what are you thinking in terms of inflation in the US, and then interest rates, and then maybe we can sort of circle back to how the US election might influence that. You've already said what you think might happen after, which is interesting. I wonder what that looks like, but you know Trump is probably going to want big rate cuts, not sort of a 0.25%. He's probably going to want, couple of hundred basis points, and that I think will be a challenge unless inflation really takes a dive. So what are your thoughts around inflation and interest rates in the US, JP?
You stole the words out of my mouth. So you and I, Eugene, we talk about basis points.
Yeah.
Trump talks about percentage points.
Yeah.
So when he has a fireside chat with Jerome Powell, and by the way, I would love to be a fly on the wall, because just between us, Donald Trump despises Jerome Powell. And that feeling is entirely mutual. It is well known in Washington that Powell really doesn't like Trump. And we know what Trump did to him via his Twitter account when he was the president. And when they have that conversation, and Jerome Powell will be talking in increments of 25 basis points. Mr. President, we're looking to normalize monetary policy. And at our next FOMC, Mr. President, we're going to table the prospect of a 25 basis point incremental reduction. And he'll look at him and say, listen, you can talk basis points. I'm talking percentage points. I don't want to see your face here again unless you deliver me 200 basis points, none of your 25 basis points. Okay. I really do honestly believe there is going to be a real clash if Trump wins, and it's something I believe. Last night, Jerome Powell delivered a statement to the House, part of his annual testimony, and he was relatively ambivalent. He said there was some progress in inflation coming down. Obviously, their target is 2%. He also acknowledged a little bit of weakening in the employment market, which I think is self-evident in the non-farm payroll numbers. But as you say, the all-important number is our time tomorrow. If you're in Australia watching this, is 10:30 p.m. Australian time. So I'm sure you'll all stay up after watching Married at First Sight. I think they ended the season, which is rather sad. But US CPI at 10:30 tomorrow night. And so the market's looking month-on-month CPI for a rise of 0.1%. And that would lower the year-on-year rate down to, what is that, 3.1%. But the core number is probably the more important one. So on the core number, the market's looking for plus 0.2% month on month. And that would leave the year-on-year core rate unchanged at 3.4%. To me, that's still quite a long way from their 2% target.
Yeah.
So they're going to need more evidence of a deceleration in the rate of inflation. But if you look at the market pricing for the meeting, the market is now 75% pricing that the Fed will cut by 0.25%. And I can kind of see that. You said it yourself just a moment ago. I definitely think Jerome Powell would like to cut rates. And I'm sure, well, I know that the talk amongst the hedge funds in the US is that Powell really, really, really wants to cut rates because he's going to do everything he can to stop Trump getting into the White House. Now, you can think that's a conspiracy theory, but I'm probably rather partial to that perspective. So yes, Powell wants to cut rates, and once he gets an excuse to do so, he will do. And I think also just around the edges, we're beginning to hear a little bit more commentary out of the Fed and its members of this weakening in the employment market. And I'm seeing that. I'm certainly seeing a weakening in the US employment market.
Okay. So yeah, and I think the market's pricing in a good chance of a rate cut in September in the US.
Yeah.
But yeah, it's hard to see drastic rate cuts in the US until the inflation numbers head much closer to that 2 or even 2.5% target
Yeah.
in the short term. But it's a far cry from 6, which is what was being priced in 6 or 7 or 8 months ago. So okay, so and then you mentioned the softening of the labor market. What are your feelings around a recession in the US at the moment?
Yeah, I'm really reluctant to ever use the R word ever again because I made such a fool of myself last year, and I'm still, I'm covered in bruises from that experience. It's been traumatic. So I was, on record in 2023. I don't know why I remind people, but I suppose I have to. I was calling for a recession in 2023. We clearly didn't get one, but there's a clear deceleration in the economy at this moment in time. I think the Atlanta Fed, the so-called GDP now, estimates around 1.8%. What was the first quarter? Was it 1.3, 1.4%? So, and that, don't forget, America produces an annualized GDP number. Everyone else in the world does an absolute Q on Q. America, for some reason, annualizes it. So de-annualize 1.4%. It's
3.4.
So the end of the day, I'm seeing a deceleration. I am still definitely in conservative camp with regard to the US economy. I have to acknowledge the resilience. I was wrong for a range of reasons. First and foremost, I underestimated the quantum of fiscal stimulus. I underestimated the resilience of the nation of shock till you drop. But we now know, of course, we have confirmed that all those excess savings they built up post-pandemic have now been spent. And we're seeing, listen to company results. All the retailers, particularly fast food, McDonald's and others, are really warning about a softening in consumer spending. And we know there's huge dispersion within the United States in terms of households. The high income households, happy days. Strong stock market, high, strong house prices, everything's fantastic. And if they've got excess savings, they're actually now getting a rate of interest on it for the first time in a long time. The low income groups are getting absolutely hammered. High inflation, because they look at cumulative inflation since 2020 to now, up 25%, more than that, I think, across a range of goods that they have to buy, the kind of pure necessities. And then, of course, they've got high levels of debt. We can see it in the credit card data. We can see it in auto loan delinquencies rising. So the lower income quartile, if not half of the US household sector, is really experiencing a lot of pain at the moment. The high income groups, happiest they've ever been. So that's the dispersion. But as time goes by, we all know from history that there is a lag between the rise in interest rates and the impact and the filtration of and transmission of that monetary policy through the economy. And I think it's now coming through. So I'm afraid I'm still very much in the more negative camp. If you took the 68 economists across the United States, there's only a few of us who are basically saying we are heading south in 2024. That's the numbers I'm looking at are telling me that. But obviously the consensus amongst, the Ivy League chief economists at Goldman's and co, they're all saying no such thing. They're all looking at a robust economy. I beg to differ, but I was wrong last year, so I have to bring that caveat in. And it's kind of a forecast I don't really want to be right about, but I am seeing a much softer economy than the great majority of economists.
Yeah, I mean, and look, a lot of people were predicting a recession in 2023.
That doesn't make me feel any better.
Sure, sure. But I mean, you're in some ways, it's probably a more contrarian call now than it was a year or 18 months ago. I've heard a lot of people refer to it as the most anticipated recession of all time 18 months ago. But throw in all the COVID savings, I think that was probably one of a very unique scenario that's kept the consumer story going. And I am seeing a lot of stats that suggest that a lot of that is now exhausted. So we could just be seeing a much more drastic lag than we have. But yeah, you can't deny the fact that the government reaction has helped, and everyone has the consumer has proven to be very resilient.